Good afternoon and welcome to the first Yellowstone Advisory webinar of 2022. We're delighted to have Rotork with us today, and I'd like to introduce Jonathan Davis, Group Finance Director, and Andrew Carter, Director of Investor Relations, to take us through the presentation.
Okay, very good. Thank you for the introduction, Alex, and I'll kick off and hand over to Andrew in a minute or two when we get a bit further through the deck. So we're going to start with some sort of background. I think Rotork is a flow control business, so we are very much in all parts of flow control, and we'll touch on some of the products of the markets and all those sorts of things as we go on. But our mission statement, keeping the world flowing for future generations, is very much sort of a thread that runs through the business. If you'd like to go on to the next slide, Andrew, we'll start with a bit of history, because I think just sort of to give the business some context. Founded in 1957, Rotork was set up by a guy who was very much an entrepreneur and an inventor in the style of those days. In 1957 in Bath, originally in the cellar of the founder's house. In 1961 we moved to the factory, which is a couple of hundred yards away from where I am at the moment, and our main UK factory still to this day. The business was unusual in a number of ways from the outset, in that first of all, we from very early days were a company that operated an outsourced manufacturing model. So we've only ever really assembled product. So on our facility in Bath, we have a big R&D facility. So we design the product, we own the intellectual property, but we've never actually really spent a lot of money on plant and equipment and processes within our facilities. We've always assembled those products. We also very early on recognized the benefit of having direct sales presence in countries around the world. So from around that time onwards, and really on beyond the 1990 point shown on this timeline here, we've opened sales offices in all of these locations and hired locals to deal with customers in those countries, bringing that sort of local knowledge of the markets and the way of working in each of those businesses as we've expanded around the world. We then went through a sort of an expansion phase through M&A, which has seen us over that sort of rough time period complete something like 40 acquisitions, building on not only our geographic coverage, so sometimes acquiring businesses that have been agents that take us into geographies, but also adding products to the portfolio through acquisition where we thought that was the most appropriate way of doing it. And product really was the focus of the business as we went all the way through up until 2020, where the divisions were ultimately structured around the different types of products. In 2020, we recognized that actually turning that into an end market focus, structuring the sales teams so that they were dedicated to particular end markets, was probably the right way forward as the business moves on into its next sort of growth phase, and what we internally call the growth acceleration program, which commenced in 2018. If we look at the sort of the world in which Rotork operates, and we look at some of the characteristics of that world, our products are found in very demanding applications. They are often critical to the operation of our customers' facility. Very often safety critical, so they operate on emergency shutdown valves, where if there is an emergency, for example, a very simple one will be a pipeline going across a river. If something breaks that pipeline, you want to shut off both ends of the pipe to stop leakage into the river. Those sort of safety critical applications are one of the areas that you would find our actuators. There's typically a high cost of failure, whether it's in our oil and gas applications, our power applications, particularly you would see that that high cost of failure. And increasingly, particularly within those markets, we see this increasing requirement for reducing energy consumption or energy emissions, and helping our customers, our end user customers, reach their own targets in terms of emissions and in terms of energy usage. Our products operate in tough environments. If you think of all the parts of the world where you find oil and gas, it's very easy to understand that in the deserts of the Saudi Peninsula, or in the Arctic, and high up in Canada, in Alaska as well, they're in harsh environments. Our products have to be able to operate in -61 to +60. So real extremes, and be able to deal with big swings in temperature as well, which is not that easy for a mechanical or an electronic device. They operate subsea, in offshore platforms where you've got salt and corrosion, and often quite inaccessible locations, as you can imagine. They are, however, as the demanding application bit sort of indicates, quite often explosion proof and fireproof. So they have to operate to really tight tolerances and maintain those tolerances irrespective of the environment that we find them in. That means that customers take quite a lot of interest in choosing their actuators, despite those actuators potentially being a relatively small cost element of the overall project that they're specifying. They therefore will take an interest in determining who the actuator manufacturer is. And our track record over many years of delivering high quality product and then supporting that product, which I'll get to in a minute, means that they will take an interest, and they will look to build a specification for their facility that incorporates some of the features and functions of the Rotork product, as well as then stipulates that it's backed up by the local service requirement. And that initial sort of phase we talked about of geographic expansion, where we've opened sales offices for direct presence in many of the parts of the world that our products are found, those sales offices also support a service infrastructure and a service team that's really important to our customers in terms of helping them when things do go wrong, because inevitably mechanical and electronic devices do go wrong. But knowing that there's a Rotork expert close by to help them when they are up against it is an important part for our customers in terms of understanding which products are advantageous for them to purchase. An actuator, I suppose it's worth saying, is a device that sits on top of a valve. So here you can see a wide range of our products. In the middle two rows on the right-hand end, you see a grey device with a 69 on the screen and a blue device. Those are both electric actuators, and they sit on top of the valve and operate the valve. They open and close it. In its simplest sense, a valve is really a bit like a tap. You open it and you close it. There are many applications where that's still done manually, and we supply manual operators to do that. You can see some of those on the third row down. There's a big hand wheel on the left-hand end. That's a manual gearbox. Something like 75% of the valves in the world are still manually operated. So one of the drivers we'll talk about is always around automation and increasingly moving towards automating more valves. We serve multiple end markets. So here we talk about oil and gas, we talk about water, wastewater, power, chemical, process, industrial, which is really a catch-all for everything that isn't in the previous ones we talked about. And our devices are range from the relatively simple in terms of those manual gearboxes through highly configured products such as the electric actuators, up to very much engineered solutions, as you can see with the red actuator on the left-hand side of the second row and the one next to it. Those are very much highly engineered solutions. But typically, all of our actuators are built for a specific customer and a specific application. So it's not really a stockable product in any sort of sense of the word. That doesn't apply to some of our instrumentation products, which you can see in the middle of the top row, where they are more standardized and can be sold through more of a distribution channel model. With our customized and our engineered product solutions, it's very much about working those specifications and selling largely actually to the valve maker, which is why being valve agnostic as we don't have valves within our portfolio is quite important, we believe, in terms of how we sell. Move on to the next slide, Andrew, and we look at the sort of the differences in terms of those products and some of the different elements of the competitive landscape in these 4 sectors. Now, these 4 sectors actually represent the way we used to go to market, and still is the easiest way to think about the competitors and some of the slightly different dynamics of the product families. So electric actuators, that's Rotork's heart. That's where Rotork started, and when we used to report on this basis, it's still around about 50% of our business, and is the one where Rotork made its reputation. We are the market leader in this space. The competitors we see in it are again, international businesses. Alma, you may not have heard of, is a privately owned German business, very good one that we see in many markets, but really started from a water and power market exposure and working with the German power generation companies, and expanded on the back of that, whereas Rotork very much started in the oil and gas space. Bernard, probably you haven't heard of those, small French business, but very focused on power and particularly nuclear power. Emerson, Flowserve, 2 big US multinationals that have valves within their portfolio as well as actuators. So relatively concentrated in terms of the top end of this market, covers quite a large share. And as I say, the place where we started. Through combination of acquisition and some development, we then expanded our portfolio of pneumatic and hydraulic actuators. So these are devices, this is normally where we find the emergency shutdown actuators. So typically you're using air or oil to compress a very large spring that's stored under tension. And then if there is an emergency, that spring closes the valve very, very quickly and without any sort of outside power. We see some similar competitors here. So Emerson and Flowserve, and Emerson is the market leader in terms of size of their presence in this market, but it's a much less concentrated industry. It's much simpler to develop a pneumatic or hydraulic actuator. So many of the valve makers around the world have their own products in this. But where we can work with an end user and define a specification, we can often still sell to the valve maker parts of Emerson or Flowserve or many of the other valve makers, and sell our products to them to then supply onto the end user. Pneumatics and hydraulics, because of that emergency shutdown piece, there's a much higher proportion of oil and gas sales within that pneumatic and hydraulic space. Gearboxes, internationally a very fragmented market, lots of suppliers within that, and we probably are the global #1 in gearboxes as well. Alma, Emerson, Flowserve we've talked about before in terms of competitors have an offering in this space. Sambo is a lower cost Korean competitor that's emerging in this area. But again, this is either for use in combination with an actuator, or potentially as an electric, as a manual operator of a valve. And then instrumentation in the flow control space is something that Rotork really started building a position in through acquisitions, starting in around about 2011. Building over time to look at a multitude of devices that either measure or control pressure or flow. It's a very, very broad space, and nobody really has a full set of products within what we would define as this instrumentation area. But we've focused on adding in niches where we can be sort of have a leading position within certain parts of it, and that are complementary to those markets that we see within where we sell our pneumatic and hydraulic and electric actuators. Moving on, looking at aftermarket. So obviously, in addition to our products, we also offer a kind of a a more integral offering for some of our customers where we will go and help them on site. Now, typically this has come off the back of our actuator sales because the instruments are typically much smaller components within the facilities in which we sell them. But actuators, there's not only the opportunity to go and service our products on site, there's also the opportunity to use our service engineers really as frontline sales lead generators, looking for opportunities to replace competitors' actuators on site, working with those end users to upgrade facilities, to help maybe change the application that's running within that facility. And we have around about 450 service people within our service business globally. And it accounts for something like 20% of group revenues in total when you include the full range of activities that they cover. You can see some of the opportunities listed on the left-hand side. Actually understanding what our installed base is has been quite a challenge, because with 50 odd years of product in the field and products that can last 50 years, actually understanding where those sales from the 1950s, 60s, 70s are and whether they're still in operation is quite a challenge. We have much better intelligence on actuators sold in the last 20 years. We're working to build that database, because that's one of the things that then is a sales opportunity to go to those end users, offering to support the customers either through our lifetime management program, which is now where we're looking at working with those customers over a number of years on long-term contracts to help them maintain their facilities. The intelligent asset management referred to there is taking this to a next level, where rather than just working on a sort of preventative maintenance basis, we can actually use the intelligence within particularly our electric actuators, like the one you can see in the middle of the picture here, to use the diagnostics within the actuator. So the actuator is the brains of the valve in many ways. Every time an actuator is operated, one of these IQ products that you can see here will measure the time that it takes to open or close the valve, the torque required, the temperature, the vibration, all of which can be used over time to plot any wear or deterioration in the valve that it's operating. We can use that to generate an algorithm and ultimately use it to predict when maintenance may be required. And if you think back to the critical applications that our products are used in and the high cost of unscheduled downtime, moving towards predictive maintenance is a really important opportunity that is of value to our customers. A couple of slides just on sort of footprint and revenue splits. As I've said, that global expansion is something that has been very important from very early on in Rotork's time. We now have something like 3,400 employees with offices in 30 odd countries, but really serving more than 173 countries through an extended network of distributors and representatives in countries where we don't have a direct presence. We have somewhere, now this is probably about a 2020 year-end slide, so I think we are something like 17 assembly facilities around the world, which we refer to as manufacturing facilities. And as you can see, in terms of geographic split of revenue, it's fairly even between EMEA at the top, Asia Pacific, both in the sort of just over 200 million pounds worth of revenue mark, and America's actually slightly below that at around 145 million pounds. That obviously, that split does vary year on year, but Asia Pacific is probably the area that has been the fastest growing over the past 5 to 10 years. If we move and we look at the revenue split by end market, which is what the pie chart here is showing, then right-hand side, adding up to 48%, is the total oil and gas revenues in 2020. You can see upstream in the bright red on the right-hand side is around about 13% of revenue, midstream 10%, but downstream is the biggest part of our oil and gas business at 25% of overall revenue. And last year, 2020, actually water and power, CPI were both 26% of revenue. So we have a fairly even split at this point between those two of the remaining revenues. We're a very high margin business. In 2014, revenues peaked at 26.4%. With the downturn in oil and gas in 2015, revenues have dropped back, and we are now building them back up. And Andrew will talk about the growth acceleration program and the objectives of that program in a moment. But we're up at 23.6% in 2020, with a return on capital of just under 32%. The business is also highly cash generative. The 178 million net cash at the end of 2020 is obviously very affected by the circumstances of 2020 and COVID, where holding cash on anybody's balance sheet was seen as a good idea. But during 2021, we've caught up on all the dividends that were postponed out of 2020. And in addition to that, I've also done a £50 million share buyback. So the cash is coming down to a more normal level at the end of this year, which we'll report on the 1st of March. I'll now hand over to Andrew, who's going to pick up some of the other aspects of the investment case.
Thanks, Jonathan, and thank you all for listening in this evening. So my first slide just talks a little bit about the sort of the classical how we create value for our stakeholders, I think Jonathan's talked through in quite a lot of detail about how we approach our customers. What Rotork stands for is innovative products and services that are actually being used to deliver customers' automation challenges. As described, we're looking for these very difficult operating challenges in difficult places, in challenging environments, and we're looking to basically be able to provide an automation solution so that a customer is able to use their staff and their employees to do other more important things rather than open and close valves. In terms of the world that we operate in, we're committed to enabling a sustainable future, and I'll talk about that on the next slide. We see the energy transition and the environmental crisis out there as being a real opportunity for us, and we think we've got a big part to play. In terms of our people, Rotork has always been a first-class employer, and we pride ourselves on the diversity of our workforce and the inclusive environment. And we poll our people regularly. We get great results in those polls, and we're really proud that the vast majority of the people who work for the company are shareholders. And it wouldn't surprise me if we find that possibly one or two of those have joined the call this evening, given the advertising that Alex has done in terms of getting people on. In terms of the financial performance and therefore the attraction for the shareholders, we're very, very proud of the high return on sales and the high return on capital employed that the company is able to achieve. And we'll talk a little bit about the growth performance as well. Given that we're able to achieve very high returns on capital, the 30-odd% that Jonathan mentioned, we believe we can also operate with quite a strong balance sheet. We don't need to operate with the levels of debt that some companies need to do to be able to achieve those returns, and that we think that makes our the business a strong business, and it enables us to operate through the cycles obviously that we face. We think that we can acquire. Jonathan again mentioned that we've been acquiring quite regularly up until about 2015. We're on the lookout for acquisitions as we speak. Sadly, we were not able to, despite a lot of work last year, we weren't able to convert that into any transactions. One of the things we're seeing in the market at the moment is that multiples are very elevated, and clearly return hurdles are very, very important. We don't want to disappoint shareholders with an investment in a business that just doesn't make sense and can't make the returns. So I mentioned a little bit about sort of how we can enable a sustainable future, and this slide gives a few more ideas as to the different ways that we can play. A number of these we see as being potentially very, very exciting opportunities. A couple of them we're already very busy at. So bottom right, we talk about water. Water, as we saw on a previous slide, is around a quarter of our sales at the moment, and we're involved in all aspects of the water sector that you can imagine. So whether it be to do with potable water, water in industry, wastewater treatment, flooding, etc., etc., we're basically seeing that business grow very nicely over time as we see water being rolled out in the emerging markets, water quality being improved in all parts of the world, and people using water in industry being more responsible for that water, not taking water from natural places, etc., etc. So the water market for us is a very exciting one, steady growing for numbers of years, but encouragingly having grown for us even through the COVID era of the last couple of years. The electrification trend is also one that we think is very exciting, and it's very much something that we're seeing at the moment. An example that we give here on the slide, so top right, is talking a bit about the oil and gas sector. One of the things that I think has only become more apparent sort of during the last couple of years, as people have looked at the climate challenge that the world faces, the oil and gas sector is actually a big emitter of greenhouse gas emissions, regardless of the end use of the fuel. And one of the things that we're seeing, a big trend in the industry, is moving away from using the oil and gas that is actually being drilled for and is being used to actually power facilities, and moving to electrify them. So one of the things you'll see, certainly if you're involved in the oil and gas industry in Western Europe, if you were operating either in the North Sea or if you were operating on the Norwegian shelf, the regulators now require those platforms to, wherever they can, use electric powered facilities rather than using either the oil and gas that they're drilled for to power their pumps, their compressors, etc., etc. And the very, very best stations in the North Sea and on the Norwegian shelf are using much, much less greenhouse gas to power themselves than historically. A couple of the other opportunities that present themselves to us are on the left side. So emissions reduction. Methane is something that Rotork has been targeting for numbers of years, and it's really, I think, become much more in focus, particularly with COP26, but actually a few months before that, we'd started to see a really big campaign by environmental bodies saying that methane is actually much worse for global warming than carbon dioxide. And the really exciting part about targeting it is that the majority of emissions can be avoided at no cost. How do you do that? One of the ways is replacing pneumatic and hydraulic actuators, which themselves could be leaking methane, and replacing them with things like our electric actuators. And one of the things, again, that Rotork has been working really hard on for many years is to get the energy requirements of our electric actuators down to such a level that even in quite remote locations where you're away from the grid, you can use things such as renewable power, solar or wind, and a battery to be able to power those electric actuators and replace these venting pneumatic devices which are causing clouds of methane that people can photograph from the skies. Hydrogen on the left there is obviously, for many people, hydrogen is a new market. It isn't really for us. We've supplied equipment for use in hydrogen applications for many years, as it says on the slide. Hydrogen is used in numbers of industrial applications, clearly industrial gases, but also things like refining, things like steel making as well. But what's very exciting is certainly in Europe, but I think in other countries as well, we're starting to see the growth of a hydrogen industry where hydrogen is being used for a lot more things. Hydrogen being basically used as low carbon energy, and the opportunity for us, we think it could be very, very significant. There are industry bodies out there that are saying that the hydrogen infrastructure could go on to be bigger than the gas infrastructure that we see in the world right now. What's great for Rotork is, as you're probably aware, hydrogen is not the easiest of compounds to deal with, and producing it, storing it, using it requires the very highest spec, very highly certified flow control equipment, which really lends itself to the kind of products that Rotork specializes in. So there's just a few examples of the kind of things that we can do. We, in all of our results presentations and our reports and everything, we talk a lot about this opportunity, and the sustainability report that we mentioned on the slide is another place to go to if you want to see a few more of those opportunities. But I thought it was worth running through in a little bit more detail. Turning to the growth story at Rotork, Rotork has got a very, very long history of mid-single to low double-digit sales growth, as you can see on the slide. So when I first started looking at Rotork as a research analyst working for an investment bank back in the late 90s, Rotork revenues were, from memory, in the region of about £75 million. So we've gone a very, very long way in a period of sort of 20 years to more recently having revenues approaching £700 million. So a really, really fantastic organic, in particular, growth story, but also the acquisitions that we've been doing in recent years. The last couple of years has been a bit more difficult for us. You can see on the slide, we refer to the 2015-16 Great Oil Bust, which caused revenues to decline in 2015, 2016 again. The last couple of years, 2019 and 2020, have also been a little more difficult. Clearly, COVID had a part to play there. We did also see an oil and gas price decline at the back end of 2018, you may recall. Where it leaves us today, I think we're more positive about the outlook as we go into 2022. The world is still a bit more difficult, but there is an awful lot of talk in the industries that we serve about catch-up spend. So particularly in the oil and gas industry, I think there's some belief there's some catch-up ahead of us. In the water industry and also in CPI, we also benefit from some of the trends such as the electrification and the automation that we talked about. And I would say in water and in a few other areas, I think there's expectation that there's going to be infrastructure stimulus coming through from various different governments, for example, China. Just a little bit more on those growth drivers, because this is obviously something we talk about a great deal, given what we have seen over the last couple of years with that headwind of oil and gas. And this is a slide that goes in nearly all of our results presentations over the last year or so. It's very much part of our growth acceleration program, which Jonathan talked about. These are the levers that management are pulling and where we're investing our money to be able to really drive the growth in the coming years. The first one of those, end market alignment, Jonathan has touched on in terms of realigning the sales force to really focus on the customers rather than thinking so much about our products. Why this is important for us is we really think that a modern industrial products company, the salespeople should be really quite specialist and really understanding what the customers are looking for and taking expertise and knowledge from one customer and applying it to sales to another. So that's something that we've put in place over the last couple of years, and it's really starting to bear fruit at the moment. The site services expansion, again, I thought Jonathan gave a really good explanation as to what we're doing in site services. This was an area, I think, where it hadn't been as centrally managed as perhaps it could have been. And one of the things that we've done in the last recent years is we've put in place central management oversight over our site services offering. And that's helped us to really provide a bit more commonality and to approach global customers and really talk about a global site services offering. And we're seeing really good growth in site services, a little bit more difficult with some of the site access issues in the last year or so, but nevertheless, I think the platform is built there for really good growth out of site services. We're really doubling down on high growth regions. I think Jonathan also said earlier on how Rotork from the very, very early days has been quite focused on emerging markets and high growth regions. But what we've been doing as part of the growth acceleration program is stepping that up further, trying to take the customer service that we mentioned in there, but also looking to develop products that are more specific to some of these regions, and in some cases local in production. Innovation and new product development is another area of real focus where we're really trying to apply the Rotork dollars. Clearly, Rotork has always been about innovation and new product development. It's what has taken the business to where it is today. But I think over the last maybe 10 years or so, it's become a little bit less focused and a little bit more regional. And what we've really tried to do, I think, with the growth acceleration program is just improve the processes and make sure that the resources are being spent in the right way. And we're starting to see the benefits from this. Again, COVID has made testing and a few other things a little bit more challenging, but we do think that the product development has got some really good momentum. What we've done down the bottom there as well is just to remind about those sort of like big industrial drivers that we sort of see on an everyday. Automation, as well as electrification, are some of the biggest trends in industry and things that we really, really benefit from. Jonathan mentioned it, the move from some kind of a valve with a hand wheel on top of it to an all singing, all dancing Rotork electric actuation solution. The electrification of, in particular, oil and gas, but other industries as well that have previously used relatively inefficient pneumatic and hydraulic solutions, and the digitalization, putting in place things like digital twins and digital control centers, and having the control system actually act the actuator and talking back to the center. And all the time, we want to be easier to do business with. So these are the kind of things that management's doing all the time to try and get that top line growth going. In terms of margins, Rotork has always been a really high margin business, and the chart here shows that over most of the years from 2008 to 2014, margins were comfortably above 25%. That decline in volumes that we saw with the oil decline in 2014 and 2015 did see margins come back by almost 500 basis points. There were a couple of things in there. One was acquisitions coming in at a lower margin. I think the second was with the benefit of some hindsight. Our cyclical resilience wasn't as good as it could have been. So one of the things we've really worked on with the growth acceleration program, again, Jonathan touched on it, working on the factory footprint, working on getting the right balance between fixed cost and variable cost. And that has helped us already start improving on the margin. So even though 19 and 20 were tougher years for us in terms of top line, we've seen margin improvement over that period. And while 2021 looks to be to do with some of the supply chain issues, it looks less likely to be a big step in margin than what we've seen. We're still very, very confident that this is going in the right direction. And the target that we've set ourselves is to get the margins back to the historical levels that we show on that chart. And we anticipate doing that over the next few years. We did touch on the growth acceleration program as we've gone through, and I think this is quite a busy slide. I do want to really get onto people's questions, so I won't go through it in a huge amount of detail. But to touch just briefly on some of the things that we've been thinking about in terms of the headline pillars, and perhaps starting in a slightly odd way, one of the first things that the program looked at was talent and culture. And I think some of the things we've talked about with culture will have come out in this presentation. In terms of talent, this was taking a really good look at the people that we had in the business and bringing in some externals to help us with various areas. So by dealing with the talent and culture, we were enabling a few other bits and pieces. So we were enabling commercial excellence in the top left, which is about the sales force realignment. It's about the lean improvement. It's about product development. It's really about getting the top line going. Operational excellence on the top right hand side was about doing things better. It's about enabling that margin improvement. It's about purchasing better, things like that. And the final on the right bottom, I've mentioned this one partly last, not because it's the least important, but because it comes in a bit later in the program, is really improving the IT and the core business processes. And this is something that the group has been very, very busy on in 2021 and will continue to be in 2022. We're going to be rolling out much better IT systems, enabling us to take more cost out and improve quality in numbers of different areas. So very, very busy on this growth acceleration program. It's something we talk about a great deal, going very, very well over the last several years. We've got another year or so to go on this. And we're looking to see the growth coming through, and we're looking to see further improvements in the margin. Just the final slide, I think, from me before perhaps passing back to Jonathan to wrap up, is just to talk a little bit about our ESG and sustainability framework. You'll be aware that in the equity market, ESG and sustainability is of paramount performance for all of our investors. So we spend an awful lot of time working from the centre with the operating businesses, thinking about these kind of things. Again, I will keep it sort of very top level, but we spend a lot of time thinking about what a responsible business looks like. We think an awful lot about what the future looks like for the world and how we can be more sustainable. And it's always been very, very important for Rotork that we make a positive social impact, and we do that, through our people, through diversity, through inclusion. All those kind of things listed there. And along the bottom, like many companies, we've tried to encapsulate what we're doing by identifying sustainable development goals, which we think that we can drive forward. And you can see with the blue bar across here, this is not just me talking. Our incentives are aligned to numbers of these things. So if we don't deliver on our ESG and sustainability, we will see it in a lower bonus and in other lower incentives. And that drops down not just from the very senior executives, but it drops down a long way through the whole organisation, which we think is really, really important. And Jonathan, I think we have one slide before we can turn to the Q&A.
We do. We have one slide which I'll try and talk to you reasonably quickly. I guess it's worth saying we are a December year-end business, so we are in the process of mopping up year ends and working out where we've landed at the moment. So clearly what I'm referring to here is the kind of guidance we gave back in our Q4 update in November, where I think, you know, there's kind of two different dynamics within the business this year. Orders have been good. Orders have been up low single digits in the first half and better than that in the period up to the end of October. So from an order perspective, we're going to see I think a year of progress. Different trends across the different divisions. Oil and gas is typically slightly later cycle. It saw the impact of COVID much later in 2020 than the other two divisions, and equally is seeing the return to growth much slower than the other divisions as we go through 2021. But obviously there's plenty of talk in the markets at the moment around oil and gas spend having been constrained for a very long time, and it's still going to need some investment and the timing of when that comes back. The other impact of changes in 2021 that has had a kind of a dampening effect on our revenue performance is actually around supply chain. I'm sure many of you who follow lots of industrial businesses have heard talk about challenges of supply chain, be that around logistics and just transportation, both in terms of availability and of cost and predictability, I would say, of transporting goods around. But also very specifically for us as a manufacturer of electric actuators, which by their very nature include chipsets. Chips, as you will have understood from looking at all the auto manufacturers, and if you've tried to buy a new car at the moment, you will have seen the lead times go out and out and out. We've been affected by the shortage of computer chips and have seen constraint on our revenue as a result of that, particularly in H2. So guidance we gave in November was for H2 revenue to be very similar to the first half, which is very unusual for us. Normally we're a business where anywhere between 53 to 55% of our revenue would be in the second half, and the margins would typically tick up in the second half. We're still anticipating margins improving in the second half, but largely as a result of a succession of price increases that we put through in the first half of the year. And then lastly, Monday was Monday only yesterday. Yes, it was only yesterday. We announced the appointment of our new CEO. So Kevin Hostetler, who has been with us since 2018, announced back in July that he intended to move back to the US with his young family. And we started a search process, and that culminated in the appointment of Gig Wynn, that is pronounced, believe it or not. Gig has been with the business since 2018, leading first our CPI division and then more recently our water and power division as well. So we did a combination of sort of internal and external search, and I'm pleased to say, with Gig being the successful candidate, we were able to appoint him on obviously very a short turnaround, and Gig has effectively taken over as CEO as of yesterday, with Kevin stepping back into an advisory role. It's really quite challenging when you have two CEOs within a business at the same time. So we felt a clean transition was best for everybody. I'm conscious we talked a bit longer than we anticipated, Alex, so probably best to hand over now and see whether there are any questions. I don't know whether anybody's sent any in to you as we've been talking.
Thank you very much, Jonathan, and thank you, Andrew. Yeah, look, thanks for a wonderful presentation. It's great to hear about a British business being number one in their market globally and doing so well. So thank you for that. We are now going on to Q&A. We've had a couple come in ahead of time, and we've had some during the presentation itself, and I'm going to try and rattle through some of these and ask you perhaps to try and keep your answers quite succinct, because they're quite a few to go through. But a reminder, if you haven't asked a question and want to do so, there's a Q&A box at the bottom of your screen, and please type it in there and we'll try to get to it as we can. So I'm just going to kick off on question of your return on invested capital. It's very high. You create a lot of value, or you would create a lot of value by growing fast. What's the weighted average growth rate on your underlying markets for your products? And are you able to grow revenues ahead of the market? And have you guided to a longer term growth rate for your business, or is there a useful rule of thumb to use?
Quick answer: yes, yes, no, yes, no. Let me try and deal with that more holistically. The challenge with estimating the growth rates of our markets is the markets are just so broad. So as we've talked about, we're in all aspects of oil and gas. We're across all types of power generation. We're in all elements of water. And I think Andrew missed out desalination. So, you know, lots of aspects of water. And then our catch-all division, chemical process and industrial, covers an even broader multitude of markets. So getting that kind of algorithm of what lead indicators could I look at is really difficult. So the focus for us is to look at those trends that we talked about on the growth drivers, look at automation, electrification, digitalization as drivers that will ensure that we exceed the underlying market growth in whichever of those markets you look at. Look at our ability, because of the existing footprint and installed base, to grow our service revenues above the general market growth, and recognize that things like the emissions focus, the ESG focus of our customers are going to drive them down the path of more electric actuation than pneumatic and hydraulic, where electrics is our heartland. That's where Rotork started. That's what our reputation has been built on. So I think we're confident with a combination of all of those that however we look at what the underlying market growth is, we should exceed it, which I realize is not really saying the answer is 7%, but we expect to do 9%, but I'm afraid it's just not possible to do that. I should just add, the growth acceleration program, one of the underlying tenets of that from day one was to grow the top line mid to high single digit over time. And we still believe that's an achievable target.
Okay.
And maybe if I can add on that, Alex, there are plenty of external consultants out there who look at things a bit like this. So looking at actuation more broadly, and what you will find in quite simple terms, they start with industrial production growth, which many people see as growing over time in the sort of like the low single digits, like 3 or 4%. They then say automation grows faster, therefore actuation grows faster than industrial production. And then they say that electric actuation grows faster than general actuation. And therefore their number that they come out with is not a million miles from the mid to high single digits that Jonathan just talked about.
Okay, thank you. We've got a couple of questions on the oil and gas sector. Sort of a general question, which is about, are you thinking, is energy transition a threat or an opportunity for Rotork? And I guess that's linked into that is, you know, if the oil and gas consumption declines at say 10%, what rate of annual sales growth does Rotork think it can achieve, let's say specifically from this group of customers?
We did a very specific piece of work on just this question before a year or so ago, because clearly it's an important thing to think about in terms of the longer term strategy of the business. I think what's really interesting is when you look at the split of our revenues within oil and gas, as I showed on one of the pie charts earlier, upstream is much smaller than the combination of mid and downstream. When we look at the kind of pattern of if we look at the split of spend across upstream, midstream, downstream, massively disproportionate amount of spend in the oil and gas industry is on upstream. And that's also the area which we would anticipate, whether that's in 5 years, 10 years, 20 years time, as we start seeing cuts in spend, it would disproportionately affect upstream first. So you've got a disproportionate emphasis of cuts on the areas that are the area that is probably least important for us as a business at this point in time. you've also got the recognition that if we are going to see some energy transition, and yet the demand for power and demand for energy from the world is going to potentially continue to increase, it's got to be satisfied by some other way. And those other ways might be things like hydrogen and other alternative sources, which actually Rotork has opportunities and a part to play in building out the infrastructure that would replace some of the oil and gas infrastructure. So when we did the piece of work, I think it was a very balanced answer in terms of the risks and opportunities. Actually meant that we could see growth going forward. I think the other piece that's probably changed in our thinking, I think it was about this time last year when we were seeing what was it, windstorms in Texas that meant they turned off all of their wind farms, and Texas had a massive power outages. And then we had big snowstorms in Germany, which meant all their solar farms were covered in snow, and there was no renewables in generating in Germany. So they were turning back on conventional power in both those locations to supply the grid. So I think there is now an understanding that whilst renewables may be the way forward, there is a transition period that is going to require something, and gas is probably the cleanest of the fossil fuels that provides that transition cover, which for us is obviously an existing market, and one that will see will require a level of investment to cover the transition period as we start seeing further declines in coal and less clean forms of fossil fuel. So
Okay.
not a threat per se.
Yeah, good to hear that. I'm going to ask this question as it's written. So I'm sure you'll be familiar with this, but it's not something I'm familiar with. How prepared is Rotork for the future possible refurbishment of the existing natural gas distribution network, or maybe you're not even thinking about bidding for it, the transition to supply the network to higher pressure hydrogen fuel in the domestic supply grid? That makes sense?
Yep, it does. So hydrogen is a much harder gas to contain and to manage through a pipeline network because of the composition of the gas. You need much higher tolerances in terms of the elements that come within contact of the hydrogen versus natural gas. The good news for us is actuators sit on top of the valves. They don't actually come into contact with any of the substance in any of the pipelines we manage. So there isn't necessarily a change in specification of the actuator just because a pipeline switches from natural gas to hydrogen. So we already have the products that we would need if the gas infrastructure in the UK or anywhere else for that matter were to move to supplying hydrogen to domestic customers. And even there are opportunities for us as that network is modernized to supply products we currently have but didn't have originally into those much smaller pipelines, smaller application, smaller down the pipelines, as it were.
Okay, thank you. We've got a compliment here, so I'll pass it on. Nice presentation, many thanks. And then a question.
Well done, Andrew.
Given the high stakes for customers, if your products fail, how do you manage the litigation risk?
Contractually, as you would imagine, but then through supporting the customers in the field with our service team. So working with our customers, we are never happier than when we can actually install and commission our products in a customer's site, because then we know it's been set up properly. We're also much happier when we are the company maintaining the product, because particularly with explosion-proof devices, it's hard to describe, but an actuator is an enclosure with a bunch of pieces around the side of it. The flame path and the tolerance on those joints between the different pieces is critical in maintaining the certification of the product. If our teams are doing that maintenance, they understand the criticality of that flame path. Not all other organizations that might be subcontracted to do that would. So we absolutely try and sell the benefits of using our own people to our customers to make sure that we minimize the risks.
Okay.
And with Alex, I'm going to say we have obviously thought about actuation as a service, but it is never a route that we've gone down, for I think the exact reason that the investor asking the question has, that would potentially open you up to a huge amount of liability. And our product is very inexpensive compared to many tens of thousands or hundreds of thousands of dollars worth of fuel going down a pipe.
Yeah. I've heard about the difficulties recruiting staff for a number of other companies that I talk to. So I think this is quite an interesting question that's come in here, which says, are you able to recruit the appropriate caliber of employees, and do you bring on apprentices as well as graduates?
We do start in reverse. We do bring on apprentices and as well as graduates. So apprentices across all parts of the business, not just sort of hands-on within the factories, but also within IT, HR, finance, all sorts of areas, as well as graduates. I think that the job market in certain parts of the world at the moment is going through a seismic change as a result of COVID and the move to work from home. I think we've seen some of the pressures of that certainly through the second half of last year, but we're continuing to be flexible where we can to recruit reasonably well, I would say, where we need to. But it's not without its challenges at the moment. So I would echo what others are seeing. And I guess every time we recruit someone into a role, we're taking them from somewhere else. And if there is this net great sort of acceleration of retirement and leaving normal 9-to-5 work as we think about it, then there is obviously a deficit in the overall job market that is going to make it more challenging for a while.
Okay. Look, I know you can't give predictions about 22, but wondered if you could give us some of your thoughts about 2022. Do you see it as a sales growth year, and do you see it as a year when margins will improve?
I think we do see it as absolutely as a growth year. I think one of the things that for us will drive revenue growth is the build up of order book as we go through the second half of 21 as a result of the supply chain challenges mean that we're entering 22 with a record December order book. We've already said that. We were very confident of that even back in November. So from a revenue point of view, but also we've got good momentum and seen good momentum in orders really through the second half of 21, even without oil and gas, really seeing that pent up requirement coming to order placement and ultimately to revenue. So I think we're optimistic. I think the challenge still remains around managing the issues around supply chain, securing supply of the chips and components that we require to build product, and start getting lead times back down to the sort of level that customers want. It's been very, very challenging for us and for all of our competitors, to be honest, through the back end of 21 to meet customer requirements on supply times. But I suspect that's equally something our customers have found challenging for their businesses as well.
Yeah. Okay. What do you see as the major threats to your ongoing market growth in each of your sectors?
Ooh, that's not a quick one. In the short term, supply chain we've already mentioned, so let's not focus on that one. I think in terms of the broader market side of things, I'm not sure how to answer that. I think we're very positive about where we are and where our products position us in each of our end markets compared with our peers and competitors, to be honest. I think some of the changes we've seen over the last 10 years that are lost within the numbers that Andrew showed earlier are 10-15 years ago, supplying actuators into coal-fired power stations was a major part of our business in India and China. That's all disappeared over the last 10 years, but it's been replaced by new opportunities. The chemical, process and industrial part of our business, that broad spectrum, has been really, really strong in 21 across a wide range of end markets. And I think we feel really good about that going into 22. So not sure I really would single out anything as particularly a challenge.
Okay, I've got an easier question for you here. Well, I think it's an easy one, particularly for a finance director. How much foreign exchange hedging do you do? We're fairly well naturally hedged when we look at a group level as a whole, but we do hedge
are kind of, we're long in dollars and euros, so there's a degree to which we hedge those over the next 24 months looking out, but not excessively. So we keep it to a relatively manageable proportion of our overall net flows. I think that the policy is up to sort of 75% in the first 12 months looking out and 50% in the next 12 after that. So, but as I say, very much of the net flows, and it is very much a net position.
Okay, we're just coming up to the end, but I do want to ask one last question about the new CEO. I'm not going to try and pronounce his name, so apologies for that. But I will ask you, should we expect any changes under the new CEO?
I think one of the interesting things when Kevin announced his plans to leave back in July, and we were out doing our investor roadshows. We were doing our roadshows in person in the beginning of August, which was nice. There was a surprising number of meetings where people said they were the first people we'd seen for 15 months, so that was good. But one of the very strong messages that came across was support for the overall growth acceleration program, support for the direction in which that taken the business over the 3.5 years at that point, and the remaining 1.5 of the original sort of remit of that plan. And I hope really that any new CEO wouldn't take 12 months to sit back, reflect, and then send us off in a slightly different direction. So one of the benefits of having an internal candidate as Gig succeed is that he's been instrumental in leading large elements of the growth acceleration program over the last 4 years, is therefore fully on board with the overall direction of that program. And whilst we might see some nuances in terms of emphasis, I think, going forward, the bits that Gig's led of the growth acceleration program are largely around the sales piece, the reorganization of the sales teams into end market focus, the driving of value selling and training within the sales teams, and a focus of the NPD on areas that are very much led by voice of customer. So I think investors will generally be reassured that that really will be the piece that Gig is likely to push faster. And actually some of the work on footprint and those sorts of things are coming to the sort of natural end that we originally envisaged for those parts of it. So no, not a major shift. Slight change in emphasis, but probably even then not within the next 6 months. But as we get to mid-year 22 and we look at the strategy and refresh that for the next 5 years, then I think we'll start to see some of Gig's thoughts and ideas come more to the fore at that point.
Well, on that very positive note, that brings us to the end of today's webinar with Rotork. So Jonathan and Andrew, thank you very much for presenting and addressing all those questions as comprehensively as you have done. Thanks to everyone else for attending. And as you exit today's webinar, you will come to a feedback form. It'd be really appreciated if you could complete that. I know management appreciate any feedback that we can provide to them after these events. So if you could complete those feedback forms. And just one last thing for me to flag up, which is our next webinar, a couple of weeks' time, 25th of January at 1 p.m. It's Oxford Biodynamics. So on that note, thank you to everyone for attending, and thank you to Andrew and Jonathan for presenting. Thank you and goodbye.
Thank you very much, Alex. Thank you.